Hello, Max right here, host of BitShares TV, sitting with Dan Larimer, lead developer of BitShares. Dan, why don't you talk a little bit about the collateralized bond market on the BitShares decentralized exchange?
The collateralized bond market is really a way to allow speculators to lend assets to other speculators, if you will. It works kind of like how Bitfinex allows users to lend Bitcoin so that people can short Bitcoin. With the collateralized bond market, it works. One user puts up one asset, which will be the collateral, and they borrow another asset. They borrow it so they can sell it and whatever they're going to do with borrowing it. As long as they repay the asset plus interest by the deadline, they can get their collateral back. So it's kind of like a pawn shop. You want to pawn off your cryptocurrency or your BitShares so you can get some dollars today. As long as you pay back the dollars, you can get your BitShares back. It allows you to borrow money. If you're in a crunch and you need some cash, you don't want to sell your BitShares because you think they're going to go up. You can borrow against your BitShares instead of selling your BitShares. Now, this system works in a very decentralized way. It allows you to lend anything against anything else, which means you can now use this to short BitShares. You can use user-issued assets. You can use smart coins. You can use any asset in the system here.
And any pair, is that correct? So you could
any pair.
Yeah,
yes.
you could use BitUSD as the collateral to borrow BitEuro.
Right, or a BitGold to borrow BitUSD.
Right.
It allows you to short anything against anything. It allows you to get interest on anything by lending for a term period, for a period.
Right.
It's a way of shorting where you're guaranteed not to be called before the due date, whereas the smart coin system has other margin call things associated with it. When you are a lender, you have to make sure that there is sufficient collateral to cover the amount you're lending plus any volatility in the collateral over the period of the loan. So you need to it's like a bank when they lend you money for your house. They don't lend you 100% of the value of your house, except for in the housing bubble. Normally, they only lend you 80% of the value of your house because, the long-term trends say that house prices might go down by 20%, and the bank needs to make sure they get their money back. So as a lender, you're saying that there's actually two ways that the loan can be paid off, and that is one to pay back whatever you lent, and the other is to collect the collateral. So you're simultaneously providing a loan and an option to pay off the loan with the collateral. So in a future version, we'll have option contracts as well, which will allow the lender to hedge just in case the collateral falls in value. But for now, the lender is providing their own option when they're lending. That really simplifies the bond market experience for the borrowers. And it means that we don't have to do complex things with figuring out price feeds and margin calls for every possible combination of assets. There are just too many combinations to do it. There's too many things to check. And it really simplifies things.